everybody has seen this chart comparison between Nvidia's price returns against the returns that Cisco saw back in 1999. In the 4 years leading up to its peak, Cisco experienced a 1,000% run up in its price, which was then followed by an 80% decline, retracing the majority of the move up. And today, over the last 4 years, we've also seen Nvidia post around 1,000% return, which is leading many to believe that this is a sign of a market bubble, that these returns are absolutely unsustainable, and this is a market that is waiting to explode like it did for tech stocks like Cisco back in the 2000s. Even the head of Bank of America's equity strategy, Michael Harnett, recently stated that the stock market is behaving like during the dot-com era, so referring to this 1999 period. Is this actually what's happening here when we compare Cisco to Nvidia in terms of PE ratio, so how expensive the companies are? We do see there is a substantial difference between the two. Nvidia today is only at a PE ratio of 26.2, despite rising by 1,000% over the last 4 years. Now, 26.2 isn't necessarily cheap, but it doesn't look anything like a bubble, which definitely was the case for Cisco at 472 PE ratio at its peak in 1999. Nvidia over the last 4 years has actually gotten cheaper. Most of the gains that Nvidia has experienced over the last few years have come from the company growing very quickly, not because investors are getting euphoric. This, by the way, is our technical chart of Nvidia that we're watching with our members. It looks like we may finally start to see Nvidia take a breather here, or at least stop climbing as aggressively as it has up until now. But the point is, however bubbly this chart may look, this is not a bubble like Cisco was in 1999. In fact, technology stocks in general are extremely profitable companies. This is a chart of profit margins that technology stocks have. So that's how much revenue they have minus their cost of doing business. And so that gives you the profit margin. And today it's currently at 26%. That's more than double what profit margins were in 2004. So tech stocks have become incredibly profitable compared to what they were in the early 2000s. These are things that you need to take into account when you're comparing today to 1999. Even the valuations of technology stocks today are at a PE ratio that's much lower than in 1999. They're currently at a PE ratio of 28. Now, that is pretty expensive when you compare it to the valuations that we've seen at any point over the last 20 years. In fact, these are valuations that we haven't seen since the dot-com era. But it's also nowhere close to the peak of the dot-com era, where PE ratios reached 50 in 1999, so almost double what they are today. And when you consider that these stocks are 2 times more profitable today than they were back in 2004, it only makes sense that these companies are more expensive than they were back then. Maybe they're expensive, but they're not a bubble. And theoretically, a bubble would look like this, which could take technology stocks another 40% higher to get to similar valuations to 1999. Now, we don't think that's going to happen. This is one of the charts that we're looking at today, and it shows us the difference in valuations between small cap stocks and large cap stocks. And you can see this chart is sitting at the same level today that we saw in 1999. That means small cap stocks are at one of their cheapest relative levels in history today, and of course significantly below the average level of valuation that they usually trade at. We think there's a considerable chance that we see this turn around in the coming months, with small caps seeing their value increase relative to technology stocks. This is one of the ongoing trades that we have on the website. These are really the trades that we try to show you where there's as little risk as possible to the trade that we're making, but lots of potential reward. Today, small caps, so the Russell 2000, remains significantly below its previous all-time high. Meanwhile, the S&P 500 is trading significantly higher than its previous all-time high. This is incredibly rare. The last time that we actually saw this happen was, in fact, in 1999, where you can see small caps were below their all-time highs, while the S&P 500 was soaring to new highs during that period. And that only lasted for a few months before small cap stocks made an incredible melt up to catch up to the rest of the market right before the 2001 recession began. So this shows you that you can have these types of large market moves even though the economy is very close to a recession, which is exactly where we think we are right now. And that, on the other hand, is a big similarity between today and 1999. Back in 1999, the yield curve was inverted just like it is today, which was signaling that a recession was not far down the road. And yet when we look at what the S&P 500 was doing during this inversion, it was making new highs, which is exactly the situation that we think we're in today. The yield curve is inverted, telling us a recession is down the road, but the stock market is continuing higher and even looks very strong. But that isn't the complete picture, because there is one key difference between today and what was going on with the stock market in 1999, and it's summed up on this chart right here that shows us the S&P 500's return over the last 5 years. And today that 5-year return is at around 79%. Which isn't bad, but it's not spectacular by any means. For comparison, you can see what was happening in 1999 right here, in 1987, right before Black Monday, and in September of 1929, right before Black Tuesday. These were real market bubbles. In each of these cases, the stock market returned around 200% in the 5 years leading up to these tops. Absolutely extraordinary returns, an overextended market poised for a steep correction. We cannot say the same thing about today's market. But what about the Magnificent 8? These large cap tech stocks are at an average PE ratio of 28, while the rest of the stock market has a PE ratio of 20. So there's a significant valuation difference between these mega cap stocks and the rest of the stock market. These are Google, Amazon, Apple, Meta, Microsoft, Netflix, Nvidia, and Tesla. They went from an average PE ratio of 13 back in 2012, and 10 years later, they are now 2 times more expensive and make up a significant portion of the total US stock market. We can see that by looking at this chart here that shows us the market's concentration of the top 10% largest stocks. And we're at a similar level today to 1999, where we also had very few large cap technology stocks that made up a significant portion of the US stock market. And of course, that didn't end too well. So do these mega cap stocks today that make up a huge portion of the market as well make the stock market very vulnerable today like in 1999? I think that's quite a fair assessment. But we also have to consider that these large cap stocks are very different today to what they were in 1999. Back then, they were known as the Four Horsemen. These were made up of Intel and Microsoft that surged almost 1,000% in just 7 years, but also Cisco and Qualcomm that surged 7,000% and 9,000% respectively, which are absolutely ridiculous returns. When we compare that with mega cap stocks over the last 8 years, we see Amazon, Meta, Microsoft, Google, some of the leaders of today's market, they've returned between around 300 and 600% over the last 8 years. Of course, these are fantastic returns, but it's almost half as much as what the large cap tech stocks were doing in 1999. The only 2 stocks that have had more impressive performance are Tesla, that saw a 1,000% increase over the last 8 years, and Nvidia, that's now at around a 10,000% return over the last 8 years. But we've already discussed why Nvidia is very different to what Cisco was in the late 1990s. So the truth is, today's market doesn't look as euphoric as it did in 1999, and hypothetically, the party could continue. Because 1, the market has not yielded extraordinary returns over the last 5 years like it did in previous market euphorias. And 2, even the most successful stocks, the Magnificent 8, have also not yielded extraordinary returns like the most successful stocks in the 1999 mania. Nonetheless, we believe that we're in the later stages of the business cycle today, similar to early 1999. And it's often right before the end of the business cycle that you see the most amount of euphoria in the stock market. One of the stocks that we think still has a potential room to rally in this phase of the market is actually Amazon. While it has had a very impressive run up over the last year, and it could be due for a short-term pullback, it has also broken out of a large basing pattern that suggests there's still more upside on the stock, and Amazon is still currently below its previous all-time high. In fact, Amazon is still trading at the same level it was in August of 2020 right here. so significantly underperforming the rest of the market. And that's despite the fact that it has seen its earnings double since August of 2020. So Amazon is effectively 2 times cheaper than it was in 2020 when it was trading at today's level. You can join our website if you want to keep up to date on how we're trading Amazon.